Bonjour tout le monde, welcome. I just wanted to, first of all, thank you for joining us for today's webinar on COVID-19 and impact investing. My name is Ina Shalala. I'm the Director of Learning and Partnerships at PFC. I would like to start with a land acknowledgement to start off this webinar. In the spirit of truth and reconciliation, we would like to acknowledge the many territories of Turtle Island on which we work and reside. These territories, ceded and unceded, are home to many indigenous peoples who have lived here for tens of thousands of years and continue to live here. As settlers, immigrants, and descendants, and as visitors, we honor and respect the many indigenous peoples of this land and territory and hope for a more just future together as treaty people. So, just wanted to give you sort of a framing for this webinar. It is part of Foundation Investing 2.0, an initiative that gathers a number of organizations, including PFC, Philanthropic Foundations Canada, but also Community Foundations Canada, Environmental Funders Canada, and the Circle on Philanthropy and Aboriginals People in Canada, and is implemented by Rally Assets and Share that we have the pleasure of having here today. And this is the first of many activities which will focus on impact and responsible investing this year. And we thought that this was a very important time to organize this webinar in the context of COVID-19 and its impact on our communities. So we have the pleasure to have a great panel today. I'll start with Jory Cohen. He's the Director of Finance and Impact Investment at the Spirit Foundation. Where he is transitioning InSpirit's asset base to 100% impact portfolio. Jory is often called upon to share his expertise within the sector and academic institutions. Hi, Jory. Kelly Gauthier is the Managing Director and Partner at Rally Assets and has 17 years of consulting experience covering both responsible investing and impact investing. And Kelly leads the portfolio of responsible and impact investment projects and works with a range of asset owners to design and implement their approach to responsible and impact investing, strategically integrating responsible and impact investing into their existing investment and portfolio strategies. And finally, Shannon Rowan is the Chief Strategy Officer at Share. She has worked in the area of responsible investing for 15 years, supporting Share's investor network in aligning their investment practices with their values and using their voices as shareholders to promote improved corporate sustainability practices. So hello, everyone. Thank you for being with us today. So before we jump into the conversation and the discussion about this very important topic, I just wanted to give you a little housekeeping before we get started. First of all, if you have any questions at any time during the presentations, please type them into the Q&A box at the bottom center of your screen. And we will try to answer as much as possible during the Q&A period at the end of the webinar. And also, I wanted to inform you that the webinar is being recorded and you will receive a message after the webinar, which will include a short survey as well as the recording and some complementary resources that we will be sharing with you. So now, without further ado, I will turn the time over to our panelists and we'll start with Shannon. Hi, Shannon.
Hello, thank you so much, Ines, and thanks to the PFC for inviting us to join you today for this webinar and part of your Wednesday webinar series, which is a brilliant name. I'm joining the webinar today from the traditional and ceded territories of the Musqueam, Squamish, and Tsleil-Waututh Nations. And as you said, we're grateful to have so many participants and speakers from across the country and across Turtle Island joining us today. I also wanted just to take a moment in light of the context and what we're talking about today around COVID-19, to take a moment right at the top of the webinar to acknowledge the frontline and essential workers, those working in healthcare, retail, transport, long-term care, and many others who are risking their own health and safety and oftentimes that of their families to allow us to get through this time and also to continue and make our lives possible. We know that these workers are among the lowest paid in our economy. And so I really want to encourage all of us as we have this conversation and we think about the things that we can do as impact investors and the kind of new economy that we want to build, that we ensure we're thinking in a way that includes the social and economic justice of these workers. So I just wanted to sort of make that acknowledgement as well at the outset. So the webinar today, thank you, Ines, for giving us some background about Foundation Investing 2.0. It's a really exciting work, and Cher is really excited to be partnered with Rally Assets and with the various partner organizations and doing this work. And so we are launching a new listserv, and so I invite everyone on the call to sign up, and I'm sure you'll get a link following the webinar where you can do that and keep in touch with the activities that we're going to be pursuing throughout the next year. So today, what we want to look at for this webinar is impact investing in the context of the COVID-19 crisis. And as you all know, the current pandemic is severely disrupting health systems around the world and also causing major impacts on practically all of the Sustainable Development Goals. COVID-19 is creating enormous challenges for small and large businesses worldwide, and particularly for the workers working in those businesses in Canada and across the world. As the world grapples with the coronavirus, urgent action is really required from all sectors of society, and that's including from investors. Not just to address those immediate and short-term health and economic emergencies, but also to think about the recovery and to think beyond that in terms of the kind of economy that we want to build. And I think foundations have a particularly important role, not only as grant makers and critical lifelines to communities and those on the front line of the crisis, but also in terms of investors, and particularly impact investors. So if we can move just to the next slide, Ines, I'll just take us through the agenda. So we're going to start with a conversation on impact investing, COVID, and resilience. And I will hand it over to Kelly, who will kick us off there. Following that conversation, we're going to look at the power of our voices as investors and look at the opportunities that we can take now to amplify our perspectives, our expectations, and our voices as investors in shaping a just recovery from this crisis. And at the end of the webinar, we will be leaving ample time for questions and answers and a more interactive opportunity there to dig into some of these topics. And so invite everyone, as you have questions, make sure you get those into the queue using the Q&A box at the bottom of your screens. So with that, I will hand it over to Kelly Gauthier from Rally Assets, and that's great.
Great. Thank you so much, Shannon and Inez. It's really nice to be here and be with everybody from coast to coast. I really love what Shannon said about the frontline workers and thinking about the people that are being affected in this crisis. And certainly that as impact investors, that's where our hearts and minds and portfolios have been from the beginning. And so I think, you know, if we think about what this crisis or this pandemic has shown about the value of impact investing, the imperative of impact investing, and how we do impact investing going forward, the case has really never been stronger. Unfortunately, there's nothing new here that impact investors weren't already focused on. We were already aware that the system was flawed, that it was fragile, that the most vulnerable were being treated, you know, unfairly and with inequality. We knew that there were gaps from an income perspective, that there were issues of when it comes to decent work and support for workers. We know that there's unequal access to healthcare. These are some of the things that are now becoming apparent to everyone and are really being laid bare. But this is what the impact community has been advocating for and fighting for and investing into for years. And so I think that the case has never been stronger. The challenge is that we're living in a moment of scarcity, and we are seeing you know, businesses go down. We're seeing governments put a tremendous amount of money out into some of the right places and maybe some of not the right places. But they're trying really hard and they're moving as quickly as they can. So for foundations and endowments, there's a really tricky tension right now in terms of how do you balance that that imperative to act and that basis of who you are and the communities that you work in every day and you try to help with the financial realities of your portfolio, what has happened to those portfolios over the last few months, and then your basic capacity and resource to execute. Foundations are obviously digging deep on the granting and philanthropy side and trying to put as many resources to bear there as they can. They're working with their existing grantees and moving emergency grants into community. And they're very well positioned to do that, and that's where they should be spending their time. I think the really interesting question is, whether you're committing 3.5% or 5% of your endowment to that. What impact investors have asked all along is, what are you doing with the other 95? And how can you use that? And I think that question exists just as much today as it did 2 months ago. And so how can you use that 95% in this sort of post-COVID world to help support the areas that we're seeing are most vulnerable in this crisis? And I think foundations are doing that in terms of what's happening on the ground. I think everybody's taken a beat and tried to figure out what they're doing, how do they operate, how do they move forward, and then they're rethinking, what does my impact investing strategy look like? How do I do this now versus the way that I did it before? Do I need to think about different structures, different processes? How do I think about each asset class now differently than maybe I did before? And maybe from a sectoral perspective too, whereas each of you have a mission alignment and thematic areas that you're focused on. Clearly in the markets, we've seen massive sectoral impacts, some very positive and some very negative. And so how does that affect the way that you look at impact investing? And certainly we're seeing foundations really dig into those issues and think about how they move forward from that perspective. I think the last thing that I'll say sort of on this in terms of what's happening in the market is we certainly are seeing an urgency, and we're feeling that urgency, not just to help the front line and to work with grantees and in communities, but there's an investor imperative here too, in terms of, as we ask philanthropists to contribute and to support the recovery that we need to see, we ask governments to do the same. We also need to ask investors to play their part. We have known for a long time that government and philanthropic capital is not enough to move the needle on the impact issues that we care about and to create the just and fair world that we're seeking. And so investors have an obligation to play in this piece too. And I think it's really inspiring to see how impact investors are taking up that mantle in this moment, not just how they were doing it before. So Jory, why don't we bring you in? I mean, I would love to hear from Inspirit's perspective about how, what sort of resilience you're seeing and what your portfolio's gone through in the last few months.
Thanks, Kelly, and thanks everybody for having me on this webinar. I am going to share my screen, but I think I'm in the, oh, there we go. Okay, if you can't see my screen, Kelly or Shannon will let me know. Thank you. This is a really interesting time. The pandemic has been devastating for so many reasons, and it's created chaos and mayhem and destruction. And we've seen something very interesting happen in the markets. What we've seen from my perspective is a sliver of silver lining when it comes to this entire pandemic, and it's in the form of impact investing. The Responsible Investment Association just released some data, I believe it was yesterday, and in Q1 of 2020, they said that 83% of Canadian responsible investing funds outperformed their peers, or the average asset class return. So from a wider lens, we are seeing that responsible investing is outperforming more broadly. But if I can take some time to run through an anecdotal example, I'll let you know how Inspirit's portfolio is performing so far. And by so far, I mean in Q1 of 2020. Just the screen right now, setting some context, and Spirit committed to a 100% impact portfolio back in 2016. And over the past 4 years, we've been transitioning the portfolio, and you can see we've made some really big progress in 2018 and 2019. And as of 2019, or right now in this moment of time, we've transitioned about just under 80% of our portfolio to impact investments. And a natural question would be, okay, well, that's fantastic potentially from an impact perspective, but how about from a financial perspective? So what we've done is charted a hypothetical $10,000 investment starting in 2016 when it comes to the Spirit portfolio versus our benchmark. And benchmark is simply industry standard indexes weighted by the asset class allocation. So really, in short, it's the stock market. It's very much industry standard. And you can see that we've outperformed, and this is net outperformance, by a little bit. And you can see outperformance in the last 2 years when we transitioned, made big transitions to impact in our portfolio. So right now we're outperforming benchmark by a little bit, which is great. But here's the interesting story. In Q1, you can see that the outperformance is quite significant when we track that $10,000 investment over time and we add that Q1 data point. You can see that in Spirit, performance is significantly better than the benchmark. And that kind of begs the question, well, why? You can see from this is an overview or a breakdown of our entire portfolio by asset class. And each asset class you'll see listed on the left with the type of investment in the fourth column. In green, you have impact investment. In red, you have traditional investment. What's interesting for us is that you'll see that there's outperformance or when it comes to our impact investments, except in one category, which is our fixed income, in Q1 of 2020. However, I should say that since inception, our fixed income impact investments have outperformed benchmark. I think that's just important to note. But you'll see the only area where we don't have outperformance, when we have underperformance, is our Canadian equities. And that's the one asset class that has not yet transitioned to impact investing. We have a total portfolio outperformance of 4.5% in Q1. And that's a lot, right? That's not just the 0.1 or 2 or percent that you may expect from outperformance. This is a significant outperformance in Q1. And we'll be continuing to share a performance story throughout the year and throughout the pandemic. But as of Q1, and actually as of, I checked in with our performance this week, I think we've widened that gap when it comes to outperformance, which is quite interesting. So for us, this is a sliver of a silver lining. There's a lot of destruction caused by this pandemic. But this is something that we're proud of when it comes to our investing, and we've seen some true resilience when it comes to performance. So Shannon, I'm actually going to toss it back to you, and I think you're going to chat about the role of social enterprises when it comes to the future economy. I'm going to stop my screen share for you. Okay.
Great. Thank you, Jory. That's super interesting to see those data points, and I'm super curious to see what the trajectory is over the course of the year. So I think that, the points that I want to make in just thinking about the role of social enterprises and different types of business models in the new economy, I think I want to start with COVID-19 is a whole economy crisis. And so what is required is a whole economy response. And many of us have been hearing a lot of reference to resilience and what it means to build a resilient economy. And so I wanted just to sort of stop and think, what do we mean by resilience? What is resilience in terms of the economy? And essentially resilience is the capacity to deal with change. It is the capacity to respond and adapt to disturbances. So I wanted to look at how we look at resilience in different systems as I was preparing for this webinar. And so I looked to ecosystems and what does a resilient ecosystem look like? And there's a couple of things. A resilient ecosystem is diverse. And the biodiversity allows those ecosystems to more effectively correct for disruption. And so what does a biodiverse economy look like? And what I think it looks like is quite a diverse and numerous kinds of actors: businesses, companies, cooperatives, nonprofits, governments, public banks, and social enterprises of different sizes and structures, playing different roles in that economy, but also really interconnected. And I think most importantly, so you have the diversity of those different actors, but I think most importantly, the embeddedness of those actors in the real economy is crucial when we're thinking about a resilient economy. And the second characteristic I think that's really important for us to think about when we're thinking about a resilient economy is the purpose of those various actors. I think that our current sort of financial return only model, which decouples economic activity and financial returns from communities and societies and ecosystems, is exactly the opposite of resilience, right? I think businesses and companies that are embedded in and coupled to the communities, regions, and ecosystems where they operate, and that are driven by a broader purpose than just delivering financial returns, are really what we need to construct the new economy with. And so that is, I mean, an awfully big picture. But I think we need to think about how we build those kinds of entities across our economy, across our portfolios, across our asset classes, and including, you know, I mean, the space that Cher tends to work in and that I'm mainly embedded in is with sort of the big corporates. So how do we build purpose, embeddedness, and into those big corporations alongside smaller purpose-driven businesses and nonprofits and government institutions? And so I just wanted to give that big frame because I think it is important when we're thinking about resilience and we're talking about what a resilient economy is. And there's no question for me that these types of innovative businesses, social enterprises, purpose-driven businesses are really, really significant to the future economy. And I think this is the task that's before us: is how do we build those kinds of organizations and investment opportunities across our portfolios. So really moving into that 100% total portfolio approach. So I think I'm passing it now back to Kelly to sort of, is it back to Kelly or back to Jory? Back to Jory, sorry, to talk a little bit about how impact investors can support their investees' companies during this time.
Thanks, Shannon. So I'll talk about impact investing from a private investment standpoint. So we're just talking about private companies where, you know, some of them might be struggling or might struggle in the future. I've had a number of conversations with our portfolio companies, and there are a few ways that we can help. One is to invest more if we need to. The other is to consider granting, if that is a possibility as well. You know, there are mechanisms like interest deferral, which are so simple that we can take advantage of. And you know, I was on a webinar update with one of our portfolio investees, and one of the investors suggested that if possible, donate the interest payments if you're in a position to do so. That's all helpful. You know, the one thing I would say is please don't ask for liquidity. We need to not do that to our investees, and I would say so even for the public markets if possible. We don't, if we can withstand our cash position, we don't need to add more liquidity. But I think at the core of it, you know, if we approach our investing in the sense that we need strong, optimized financial performance in the short term, we will fail as a fund, and we'll fail our portfolio companies. So there are certainly mechanisms that we can do. And the most basic, I think, is just interest deferral. So Kelly, curious, how are leading impact investors leading into this situation?
You mean other than in spirit as a leading impact investor? I mean, I love what you're talking about, Jory, in terms of some of the simple things that you can do with investors. And certainly we've seen that broadly, not just across our country, but within our sector globally. You know, Jory talked about interest deferral. We've also seen, you know, other innovations like bridge loans and unrestricted lending that's not just granting. And in cases where we're looking at companies and businesses that have, you know, deferred revenue as opposed to a broken business model, we know that that capital is going to come back online for them. And so this is a timing and liquidity issue, as Jory said. So to the extent that you can push some of those obligations out and allow them enough space to breathe and figure out how to do what they're doing, keep in mind that these are organizations that we believed before the crisis were critical for vulnerable people and vulnerable communities. And if you don't think that those same businesses are even more important right now, the work that they're doing in communities is even more needed now than it was 2 months ago. So allowing them some room to breathe from a financing perspective is really important. I think there's also some really interesting innovation happening globally, and certainly we're seeing some, you know, impact investors take up various challenges. You know, Impact Alpha has challenged their community to 10x their commitments to impact. So whatever you plan to do in 2020, can you do 10 times that from an impact investing perspective? And there's been, you know, a tremendous response to that in the United States. The GIN has challenged folks to really double down on their impact and to consider how, not just how many dollars are going out the door, but the most impactful dollars, and for impact investors to rise to that challenge. I think that we have seen, there is a bit of regional discrepancy. I think whereas in Canada we've seen grant-based and philanthropic-based funds spring up quickly and come to the aid of communities and support communities, we haven't seen the same thing happen from an impact investing perspective to the same degree that we have in some other regions. And so I think that's an interesting thing to think about in terms of how we layer that capital. Richard asked this question on the chat just now, but around different forms of capital and pairing them together. I heard earlier Anthony Buglevine talking in the United States about the nonprofit finance funds work, and how when they initiated some of their grant work, that they partnered with the Ford Foundation to add a layer that was for impact investing. So to think about the right places for grant capital, the right places for impact investing capital, and the right terms for that. I think one of the other interesting things that I've heard too around what impact, you know, leading impact investors are doing is thinking through the governance models and what does your investment process need to look like now, and how can you change, you know, from a governance perspective what you did before. Certainly boards and investment committees and staff are keen to help, they're keen to innovate, and are really open and interested for the most part in thinking about how we do things differently. Where are there places that we can make this happen a lot faster, right? You know, we have seen this across sectors and industries, things that we thought we could never do, that would take too long, that we couldn't stop, we couldn't pivot. We've seen massive pivots already in the last 8 weeks, let alone what we have, what's online and what we're going to continue to see as we move more towards a recovery. So, you know, I think there's some really interesting innovation happening out there, and we can rely on some of those leaders to lead the rest of us and to set great examples, and also create vehicles that other people can join into, right? The impact investing sector is known for being collaborative and supportive, and allowing places for folks to join in, whether they're big or small. And I think we need to depend on that more today than we ever have in the past. And I'm sure we're going to see those structures happen. Shannon, do you want to talk maybe a little bit more from, you know, a stakeholder perspective and a shareholder perspective about how investors are leading and what some of, you know, that side of the fence looks like?
Sure, thanks, Kelly. Yeah, so if Ines, you can move forward, I think, 2 slides. And one more, there we go. So yeah, I wanted to a little bit pivot and talk specifically about some opportunities for foundations and impact investors right now, particularly in public markets, to use your voices and to express expectations of companies with regards to the COVID-19 crisis. As you know, the decisions that companies are making today, particularly in terms of where they are spending shareholder capital, and in some cases, government capital and emergency funds, those capital spending decisions will lay the groundwork for a recovery in the future economy for quite some time. And so this is the reason that I think that using our voices right now as investors is so critical. And there's really 3 ways that we see that foundations can participate and use their voices. And the first is really through using your shareholder rights to vote on company business at annual and special shareholder meetings, which this is, as you know, AGM season. And so there are a number of things coming up on the ballots of companies in your portfolio that matter in terms of the current pandemic and crisis. So as you know, most common stock, just to give a bit of background in terms of what proxy voting is exactly, carries the right to vote at shareholder meetings. And although shareholders can attend and vote in person, the vast majority of votes are actually done by proxy. Many of you, most foundations, likely delegate your proxy voting to your investment managers, and others may hire a proxy voting service as a separate entity, as a third party to vote on your behalf. So some of the things that you're voting on, your investment managers or service providers are voting on at the moment include sort of regular business, like the election of directors, for example, appointment of auditors, executive compensation. But the other things that are also emerging on the ballots this season are those issues being put forward by shareholders. And those might be related to things like decent work and human capital management. They might be related to issues around Indigenous rights, issues around supply chain and human rights and forced labor, for example. So those are the kinds of things that are being voted on. So for those of you out there, I think just in terms of understanding how your votes are being cast and who's executing those for you, what kinds of guidelines do they use to make those voting decisions, those are really, really important steps that you can take right now. And I'll talk about some specific votes coming up in a few minutes to give you a sense of specific opportunities where you might want to make sure that you're looking at how that vote is being cast. The second area in terms of how foundations can use their voices and participate actively in capital markets is really around engagement. And this is shareholder engagement is really about proactively talking to companies about issues of concern to shareholders. In the current context, it is critical that companies are hearing from shareholders about their expectations on their response to the COVID crisis. And again, I'll talk about more of what some of those expectations might be. But again, this is an opportunity to be actively communicating to companies in your portfolio about the steps that they're taking in the current context around COVID-19. And the third area is really just broadly advocating or speaking publicly. And there are numerous opportunities for foundations as investors to be communicating expectations publicly. And that might be through sign-on letters, for example, that may be going to either regulators or a large group of companies. There have been a number of public statements you may have seen, talking about investor expectations with regards to company responses to COVID-19 through media, talking in terms of op-eds or participating in media opportunities on radio to talk about not only the role of foundations in terms of their grant making, but also in terms of their role as investors and shareholders. And so those are really, really important opportunities. And your voices as foundations can be really quite powerful there. So if we go to the next slide, I just want to talk a little bit about a couple of votes to make the case around why proxy voting matters. And these are two examples of recent votes that happened over the past 3 or 4 weeks. And I'll talk about the Walt Disney Company first. So one of the things that comes up on the ballot very, very often is around executive compensation. And so most companies in Canada and companies in the US provide an opportunity for shareholders to have a say on pay, as it's often referred to, in terms of how executives are being compensated. And this is an important opportunity, particularly in light of growing inequality, for investors to cast those votes quite intentionally. So Walt Disney Company paid its CEO 911 times the median employee wage of Disney employees. The top 5 executives at Disney were paid a total of $93 million in 2019. And this kind of pay is happening at the same time where we're getting reports of Disney workers, employees sleeping in their cars, having problems making rent payments because they don't get enough hours. They're paid below a living wage. And also don't have health insurance. So this was the vote that was put forward at the Disney AGM. 46% of shareholders voted against that executive compensation package, which is a very high vote against a pay package or any vote on a ballot, actually. But it's not a majority, right? And so still, we had 54% of shareholders supporting that executive compensation package and saying, we think the Disney CEO deserves 911 times the median employee wage. So, it's really important to understand how you're voting on some of these executive comp packages and making sure that those votes are aligned with your broader values and your mission and how you want those rights to be used on your behalf. The second vote is a very exciting one to report. This is a proposal that was put forward to Ovintiv, which was formerly Encana. I don't know who came up with the name Ovintiv, but I'm not a big fan. Anyway, and this was a proposal asking the company to disclose targets for greenhouse gas emissions reductions. And that request is certainly in line with expectations globally. It's in line with the Paris Agreement and also in line with both federal targets and the Alberta Climate Leadership Plan. And so we were really happy to report this is a proposal that Share put forward alongside one of our clients, and that vote got 56.41% in support. Which is a significantly high vote for an environmental issue. And so this, shows that getting out the vote, making sure you're using those votes to communicate expectations of companies, even within the current context of COVID, is so important. That despite the current crisis, and perhaps actually because of it, shareholders are expecting companies to stay on course when it comes to their commitments and the transition to a low carbon economy. So if we can move to the next slide, I just wanted to talk a little bit about why engagement matters. Engagement, as I said, is how shareholders express to companies what matter. And there's a fairly dominant narrative out there in capital markets telling corporate boards that, business as usual is the best way forward, and that what matters, where their focus should be, is really on maximizing shareholder returns. And often that narrative is focused on the short-term returns, right? It's focused on next quarter's earnings as opposed to building more value over the long term and a more resilient company. So when we're silent as shareholders and we're not, expressing our expectations, we're just amplifying those messages, right? We're just allowing those people to dominate and that narrative to dominate. So using our voices is so important and so critical right now when, as I said, companies are making very, very significant decisions about capital allocations in these moments. And so that's, you see on the screen, on the slide here, some of the things that other kinds of shareholders are putting out there and making sure that corporate boards and management are hearing. and the quote there is actually a quote by Nelson Mandela. I should have put his name, but fools multiply when wise people are silent. So my request to all of you on the call is to not be silent. And I just want, if we can go to the next slide, and then, yeah, so this is very brief. I just want to talk about what some of the expectations that we're putting out to companies amidst the COVID-19. So we've communicated with many companies on the TSX 60 about priorities related to prioritizing worker health and safety, maintaining paid leave if people are unable to go to work and following stay-at-home orders, maintaining employment as much as possible, and also looking to maintain supplier relationships where possible. We've done quite a bit of work around ethical financial management, and particularly Jory touched upon this, but the idea of, you know, using mechanisms like dividends payments at the moment, and share buybacks, for example, in this current context. You know, we think those are not the ways companies should be using any cash on hand or liquidity. As I said, as Jory alluded to earlier, in terms of expectations for companies. We're also talking to companies around pushing through consultation at the moment with Indigenous communities, and not respecting the fact that Indigenous governments right now are fairly preoccupied with the health crisis. And so we think that those consultation requests and processes need to be stalled, and we need to respect the self-governance of Indigenous communities. And obviously we want to see, as I mentioned in the Ovintiv vote, we want to make sure that commitments remain and hold firm with regards to climate change and the Paris Agreement. And I just want to mention 2 upcoming votes so that we can all be activated going forward. If we go to the next slide, we do have a vote coming up at Tim Hortons. This is a vote put forward by the Atkinson Foundation, and it's asking the company to report on how it's upholding decent work practices across its operations. This is a vote that we actually put forward last year, and we got over 60% of independent shareholder support for. The company proceeded to basically ignore us for the year and not take any steps. And really what we're asking is just for some minimum standards around occupational health and safety, around working hours, around scheduling, for example. And the company has really not been willing to come to the table. So if people want more information on that vote, please get in touch. And Brookfield, one of the largest employers in Canada, we're also asking that the board have accountability for the way it treats its workers. We think that board oversight of human capital management across companies' operations is really important. Again, I won't go into too much detail, but this is a vote coming up. The AGM date is June 12th. If people want more information, please reach out. So these are votes that you can take to your managers and ask what their intention is to vote on those, you know, and see what their analysis is around decent work and worker rights in the current context. So I'm going to stop it there, and I think we're going to move to questions. I see that we have a lot of questions, I think, coming through. I just want to see if Jory or Kelly want to add anything. And if not, I will start to look at some of these questions and to pitch them to Jory or Kelly. All right, so one question that we have that's come through, what actions can foundations take to respond to the social and economic impacts of the crisis at a national and regional level, including supporting movements such as Give 5, Impact Response, others? So I will see if Jory or Kelly want to take that on.
Yeah, sure, I can. I'm sure Jory's got thoughts too. I mean, I think what we tried to outline through the various questions that we covered today were sort of the big guys, right? So you're going to grant, you're going to advocate, you know, and so what Adam's mentioned there in terms of some of the initiatives around Give 5 and Impact Response that the SVX is working on are ways in which you can engage with this community to help to move some of these initiatives forward. So In addition to the advocate version that Shannon talked about from a shareholder perspective, there's obviously a big role for investors to play from a voting and shareholder engagement perspective, and then you're going to invest. And so thinking about the ways in which you can use that capital in each of those various forms to help support the issues and the humans that you care about is sort of the framework in which we were trying to break this up. Jory, did you want to add something to that?
Yeah, I think that's, I mean, increased levels of granting, increased levels of investing, but also the pace of decision making has become much more rapid.
Yeah.
So there are, you know, pandemic funds being set up, there are investment opportunities being looked at, and the rate of decision making is way, way quicker.
Has to be.
Okay.
I think that rolls into the next question really well. So Jory, do you, you know, the question was, are there specific impact investing opportunities that, that we can bring to the fore? So what are you seeing in terms of, you know, as a foundation, you get pitched stuff all the time, but what are you seeing?
There's opportunities everywhere. So the existing investments that are in our portfolio and other portfolios probably need more capital, or so that's a good starting point. But there are certain investments opportunities that are emerging in response to our crisis. There's one organization, I don't think it's public yet, so I won't announce them, but I'll announce what they're doing. They're putting out a call for investments around getting more newcomers into the healthcare sector. So they're looking at an affordable cost of capital in order to lend money to newcomers in order to get them in our healthcare sector very, very quickly. There are many, but at the moment you still have to dig for them, and we're hoping to. I don't know if the SVX is looking at this at all, but I know in the States they've done this, but in order to have one place, one database where emerging opportunities can come to light, I think could be quite helpful.
Yeah, I think the other thing I would add is, you know, maybe a slightly different pivot on the question, which is, you know, specific impact investing opportunities related to COVID. I mean, COVID is touching everything, right? So I don't know what is not related to COVID at this point. And I think if you know, or you have been talking to fund managers and impact investing opportunities that were in existence before this crisis, let me tell you, trying to raise impact investing dollars in this moment, or capital of any kind in this moment, is hard. And so if we think about the conversations that you were having before COVID hit, those funds are still looking to raise capital. They're still looking to close capital, and I'm talking on the private side primarily. And if all of our capital goes towards the most urgent frontline needs, and we don't think about the medium and long term of this recovery, then we're going to create problems for ourselves down the road. So I think, and I think there are some really interesting work happening by leading investors that are having these conversations to say, what do you need now? How can we support you right now? And to the points of liquidity and emergency grants, but what are you going to need in 6 months? And what are you going to need in 2 years? And so the different asset classes and different types of structures can allow you to participate along that spectrum.
Kelly, there's a question here. It's building again on sort of the conversation around the creation of more retail and individual consumer impact investing opportunities, and whether COVID-19 will, you know, lead to more creation of those kinds of products or not.
I don't know. I think that the barriers that existed for those products before COVID haven't gone away. There's regulatory barriers, there are systemic barriers within big FIs. I think what is true is that, you know, the big financial institutions and the banks that hold most of those retail investments, whereas they may have had, you know, an evolving sense of ESG issues and impact prior to this, certainly this has brought many of these issues to light. And if they didn't have a view on ESG and they weren't thinking about those sustainability issues proactively before, I think unfortunately this crisis is going to make that much more prevalent. And so perhaps that'll lead to more retail innovation. I think some of the structuring and risk issues are going to remain the same, but I mean, I hope I'm wrong.
Just from my perspective, you know, I think there's, you know, impact investing as a whole will outperform significantly compared to traditional investment. So from the public market perspective, I think some investment managers will take a look at this and say, well, that's really interesting. I like to outperform, so maybe I'll put out more products that has a higher probability of doing so. That's from a public markets perspective. From a private markets perspective, here's what I think will happen. I think there'll be more opportunities to invest. The reason being, I unfortunately think many not-for-profits and charities will find it difficult to fundraise when it comes to granting. So they will be forced to raise capital from a different medium. And I think many of the impact investment opportunities in the private markets that we've seen are the result of being forced into raising capital that has a cost. So essentially that isn't granted or donated. So I actually do think more not-for-profits and charity will be in a position that in order for them to raise capital, they'll have to go to the market. And in this case, it might be more private placements, more retail opportunities for impact investment.
Yeah, and Eugene's just brought up in the chat the Bankability product, which he's absolutely right. So they've come to the market with a term deposit that's retail accessible. So it's a really interesting piece too. So I think we'll see more of those pieces.
So a couple additional questions we have here. One is on how do you assess acceptable levels of bankability of the investments in your portfolio? Is there a typical threshold? Jory, Kelly?
Sure. Yeah, no, happy to. You know, I'll say, at least from my perspective, every investment decision that we make is in relation to the entire portfolio. So we may, you know, we may have an investment that earns 1%, we may have an investment that earns 10%, but it's all in relation to our target returns, and returns being financial returns, carbon footprint, impact returns. So to answer that question, what level of bankability, it's really dependent on where we are in our portfolio, but also it's definitely case by case, and it's not just about bankability. It has to do with, well, what's the impact? What's the risk? What's the return profile? Do we need liquidity? There's a lot that goes into decision making, but I'll say this: if there's an opportunity that has a good business model, a business model that's built around impact, the risk is mitigated in some respect, then I think there's definitely room for conversation.
Anything to add, Kelly?
No.
Okay, we have another question around, is there anything smaller nonprofits can be doing regarding impact investing, be it planning or strategies on how to spend out money or save that might be helpful for their long-term health coming out of this?
Jory?
Oh, it depends. I mean, it depends on your cash management. Right now, your cash levels depends on your needs. So if there is extra capital, I think that's the question. Can not-for-profits make impact investments? Absolutely, they can. But again, I would urge every investment that you make to be part of a wider strategy. So if you're a small not-for-profit, you have some money in the bank, when will you need that money? Do you want to, if you want to make an investment, should it all be in one company or one opportunity, or should it be more diversified? Those are questions that you might want to ask. But if you're very serious about making impact investments, so money that you expect and you hope to get back after a period of time and potentially with a return, then there are opportunities. And I would say, what's your mission as a not-for-profit or a charity? Maybe find opportunities that support that mission and are in line with that.
I think I would just add, sorry, Shanna, that in terms of thinking about this outside of an existing strategy, so for foundations where they're looking at doing impact investments for the first time, right? So how can I support, what can we do to help in this time of crisis? How can we use more of our portfolio? If you're not currently doing any impact investing, then leaning into something new can be scary and risky and is going to cause people probably some concern. So I think there's a few things that that we've seen that have been successful in the market. So one is stay close to home. So if there are different structures with known entities that you can invest into, be those your grantees who are looking for different types of capital that you can reinvest, or they're co-investments with other investors, other foundations you've worked with before that have some experience doing this. Those are safer ways to dabble into a new type of structure than sort of running head in. And so I think there are different ways that you can couple up to help move your capital more quickly and not have to necessarily spend 6 months building an impact investing strategy that needs full board approval. There are ways to move forward, but find your trusted allies in the safe spaces in which you can do that.
Yeah, absolutely. I was going to just say, who else can you talk to and collaborate with? So are there other nonprofits and partners that are having similar conversations and questions? If you're pooling your resources together, probably can access some more opportunities. The last question I think we have time for here. You've brought both the need of economic recovery with long-term view and the increase of pairing capital together in the recovery. Could you share your perspective on having a common impact return measurement framework across blended capital investments, such as the UN Sustainable Development Goals? So yeah, I think absolutely there needs to be measurement around impact investing. There's a lot of greenwashing out there, particularly coming from the public market side. A lot of product, not much impact measurement or poor impact measurement. And so I think we need to be increasingly critical and making sure that we're understanding the impacts that we're actually generating. And I think, yeah, the UN Sustainable Development Goals are probably the principal framework that people are using globally. And we certainly see, if we look across to Europe, much higher use of the SDGs as a framework by a much broader group of investors. So you're actually looking at large public sector pension plans, for example, who are measuring their impacts and performance against the SDGs. So that's what I would add there. But I know both Joy and Kelly have lots to say.
Yeah, so I think I would 100% agree, Shannon. I think there are a few other frameworks that you can look to. So the IFC operating principles on impact management is another one. And there was actually an article published in the last day or two by the head of the IFC talking about how those signatories have committed to measuring impact, what that has meant, and really espousing that he believes that even by this summer, they will have a common methodology. And they're mostly European based, but a common methodology for measuring impact. And so whether that's true or not, it's important signaling, and it's an important momentum in that direction. There certainly are Canadian and North American investors on that list and folks that are following the same principles. And it's slightly closer to home, the common approach to impact measurement that is based out of Carleton. It's a collaboration that is working together across Canada to look at how to commonly measure impact to, again, assure that we have some standardization. And so these are some of the things that we're using at Rally and that we're a part of. We certainly measure against the SDGs also, but again, trying to work with some of the common standards so that we have a common language that we're talking.
And if you want to see an example of a portfolio, like private investments and public investments, measured across a common metric, so we've done that in Spirit, and we have chosen the United Nations Sustainable Development Goals as one of the metrics that we use, along with carbon footprint and environmental, social, and governance performance. Take a look at our website, spiritfoundation.org, click on Impact Investing, and click on our performance, and take a peek, and I think you might find it interesting.
Great. Thank you, Jory. I think we are at the end of the hour and just a few minutes over. This was great. Thank you for allowing us to participate. I invite everyone to keep in touch with Foundation Investing 2.0. As I said, you can sign up for our new e-newsletter that will be gathering all this kind of information and letting you know about future opportunities to come together. Kelly, do you want to say anything, Ines or Jory, as we close out?
No, thanks so much, everybody, for tuning in, and hopefully we've inspired you to go out and make some COVID recovery impact investments and support this sector. I think certainly Jory and Shannon and I are all happy to answer questions offline too, and happy to engage with you. So look forward to hearing from any of you who want to discuss anything further.
Jory, any final thoughts?
Thank you for having me, and stay safe, everybody.
Thank you. Thank you, everyone. It was a very, very interesting conversation and only the beginning of our Foundation Investing 2.0 learning program. So it's great. I just wanted to remind everyone that they will be receiving a short survey in a post-webinar email, which will also include the slides and the recording, a link to the recording of the webinar. And I invite you also to sign up for our weekly digest on the PFC website to receive more information about our weekly webinars. We have very interesting webinars lined up for the following weeks. So we really appreciate you being here today. And thank you, Jory. Thank you, Kelly. And merci, Shannon. And I guess I see you next time. Thank you.